Hey everyone, welcome back to another edition of the Financial Planning Education Series for court reporters. Today we're going to be talking about setting up a solo 401k. Who's the solo 401k for? When does it make sense to do it? And then if you are going to set it up, or even if you have one right now, how do you maximize that solo 401k? So let's dive right in. All right. So solo 401ks, they're a great plan to have as part of a business plan to be able to add money into retirement and start to get some tax benefits and grow your accounts. I would say it's the premier plan to choose, but we'll talk about when you should do it and, why it's not the best fit for everybody. So what is the solo 401k? So first and foremost, it's a retirement plan, right? The 401k side of it means really just how it works and how it functions and what regulations it follows. Because it is a 401k plan, it actually is governed by ERISA. And so there's special rules that 401ks or solo 401ks have to follow. So there's a little bit more paperwork that goes into them and a little bit more rules that we need to abide by. But in general, it's just a retirement plan. And think of it as like the wrapper on the outside of an account, right? So we have the money in an investment account that you can grow and invest in whatever you want. And then the wrapper on the outside is just what are the rules and tax laws that govern the investments inside of that account. So you're just choosing what you want that wrapper on the outside to look like. And solo 401k is one of those options. There are some unique benefits and features to the solo 401k that aren't available in other retirement accounts. But one of the main rules with the solo 401k is that you have to have no full-time employees. So it's really only for you. The only option is that if you have like your spouse working for you or you pay your spouse an income, but outside of your spouse, you can't have any other employees at all to be doing a solo 401k, which for most of you core reporters, not really an issue anyway. So we're good. As far as other options that you can choose from outside of the solo 401k, there's also SEP IRAs that you can contribute to. We have simple IRAs and traditional IRAs. And as you can see with all these, they're not 401ks, so they're a little bit easier to work with, a little bit more simple, for lack of a better word, than what you have through the solo 401k. And I'll show you a breakdown here in a second of kind of these different options to choose from and what are the pros and cons of each. Before we get to that, just looking a little bit further at the solo 401k and the benefits of that account specifically. First and foremost is that you get to contribute as both the employee and as the employer, which isn't true for all retirement accounts. So because we have two sides of the coin that you can contribute into these accounts, that's one of the reasons why the contribution limits can be so high for this type of account. So we can contribute as an employee of our own business. And this would be if you're an S Corp, it would be off of the money that you pay yourself as a W-2 salary. As a sole proprietor, it's just all your income you can choose. 23,500 is the limit for that. Then on top of that, we can do a catch-up contribution if you're over the age of 50. So we can do the 23,500 plus the 7,500. So we're doing 31,000 in total as just the employee for this account. Now, the real big kicker is on top of that, we also get access to an employer contribution, which is essentially like a match for your 401k, but it's really like a profit sharing plan because you can do whatever amount you want as your match on the employer side. It's not like you have to do a set percentage or 100% of what you contribute or anything like that. It's really just adding money as the employer on top of the employee contributions. So for that account, you can do up to another 25% of your pay. And so it's 25% of what you pay yourself. Again, if you're an S Corp, as your W-2 salary. If you're a sole proprietor, then it's just 25% of your net profit in your business. The maximum you can do between all of these three buckets combined is, if you're over 50, is 77,500. If you're under 50, just subtract this one out. So it'd be 70,000 in total between these three different contributions. Just remember though, in order to hit that, it's a little bit difficult because just between these two alone, you're doing 31,000. So you still have wiggle room for another 46,000 a year on top of that, but it's only 25% of what you pay yourself. So you're going to have to pay yourself pretty hefty wages to be able to give yourself the capacity to max out this plan. So that's something you need to figure out with your financial advisor or CPA is how much do I want to pay myself as a W-2 salary and force myself to pay more self-employment taxes in order to get more money into this solo 401k and grow that account. It's a catch 22 there. You want to be able to get more money into this plan, but then you don't want to increase your self-employment taxes. So you got to figure out what's the right balance for you. So here's a breakdown of each of the different 4 buckets that I mentioned. So we talked about the solo 401k and the $70,000 or $77,000 contribution limit that you can contribute to this. We also have traditional and Roth options available for the solo 401k, which is great. So you can pick whether you're doing pre-tax or Roth. And just a quick summary of the difference between the two. A traditional 401k, IRA, doesn't matter. If it has the word traditional in it, basically what it means is that you get a tax deduction now. So you get to subtract whatever you contribute to this account, that's a traditional account, off of your income for this year. But the government's not stupid. They know you're going to have to pay those taxes eventually. So essentially all they're doing is letting you defer when you pay your income tax on that money. And so you defer it all the way till retirement. They're actually your silent partner in your investment accounts, even though they won't tell you that. And then when you get to retirement, every time you take $1 out of that account, it's $1 of income for that year. So you're just deferring those income taxes to later. So for some people, that makes sense. For other people, they want the complete opposite. They want to pay their taxes right now, get it out of the way, and never have to pay tax on that money again. So if you wanted to do that, you would look at setting up a Roth account. So again, Roth 401k, Roth IRA, there's different types of the retirement accounts to choose from, but if it has the word Roth in it, it means pay your taxes now, no tax benefits whatsoever today, but that money gets to grow tax-free, and then you could take it out tax-free in retirement. One other unique feature of a solo 401k is that you do have loan provisions available. So again, there's special rules with 401ks that are not the same for IRAs. And in a 401k, you can loan money to yourself from the account. Typically, it's the lesser of half your balance or $50,000. So whatever's lower, you can take from that account as a loan. And then you would just pay that back over time back into the account. It's very rare that people do this, and usually it's not recommended because this money's earmarked for retirement. We don't want to be taking from this account prematurely, but it's good to know that is like another backup option that you have, another emergency fund lever to pull from if you need it. The SEP IRA is going to allow you to do 25% of your income. So again, if you're paying yourself a W-2 salary as an S Corp, and you pay yourself 60 grand a year, that means you can only do 15,000 into this plan. So it's 25% of your W-2 salary only, but there is a high limit on this one as well of 70,000 a year. So again, it's just, what do you want to do? Do you want to pay yourself a huge salary and have more self-employment taxes, but then you get to put more money into this plan? Or do you want to pay yourself less, not have as much self-employment taxes, but then not be able to put as much into the plan? So that's something you got to figure out what you want to do. With right now, there is no Roth option as well for SEP IRAs. There's also no catch-up contribution for those 50 and older. So it's a little bit more bare bones than what you get with a solo 401k, but definitely still a great option for a lot of people. Next is the simple IRA. Now, the simple IRA is kind of a smaller version of the solo 401k. You're back to having contributions as both the employee and as the employer, which is great. So you get two sides of the coin again, but you don't have as much flexibility. And so what I mean by that is on the employee side, your contribution limits are much lower. So it's this 16,500, or again, there's a catch up of another 3,500. to get you to 20,000 total if you're over 50. But now for the matching side of the coin as the employer, you can't do whatever you want. You have to choose when you set up this plan. Are you going to do 3% of your compensation as a 3% match? So you'll match every dollar that you put into your own plan up to 3% of that salary that you pay yourself. Or are you going to do a 2% non-elective, meaning that you're just going to do 2% of your salary on the employer side, regardless of if you make any contributions as the employee. So it's just set in stone that you're doing either the 3% or the 2%, and you have to stick to that, and you have to do it every single year. You can't choose to do it one year and not the other. You can do that with the solo 401k. So again, it's a little bit more strict on this plan. Lastly, is the traditional IRA. This is actually not an employer plan at all. You can set this up at any time as an individual. So it's a little bit more simple, but also a lot less contribution limits. Your annual contribution here goes all the way down to 7,000 or 8,000 if you're over 50. And the $7,000 limit, it's combined between the two plans. You can't do 7,000 pre-tax and 7,000 Roth. You can only do 7,000 total between the two. So you got to pick what you want to do there. You may not be able to get a tax deduction with this as well if you do the traditional. So usually with the traditional side, you always get to deduct it off of your income, like I mentioned for these other plans. But if you set up one of these other employer plans, these other three, and then you also try and do this plan as well and kind of like double dip between the two, they'll cut you off and they won't let you get a tax deduction. So if you have a work plan that you set up, like one of these other three, you can't also deduct this plan and the traditional and Roth IRA. So you got to be careful of that. That's why I would recommend you just pick one of the four. You don't try and do traditional IRAs and do SEP IRAs at the same time. It just gets too complicated. And I see too many times that core reporters are doing that. And then they end up not being allowed to. We have to go back and retroactively fix it. So if you do decide to set up a solo 401k as a court reporter, how can you maximize that plan to really get the most out of it? First and foremost, you want to do the contributions on both sides of the coin, right? Do the $23,000 limit as the employee. Give yourself as big of a match as you can afford on the employer, but make sure you stay within the appropriate ranges. Also look at setting up Roth options and setting up a Roth 401k. That's definitely another presentation I can go through about when you should decide whether you want to do Roth or pre-tax, but you can look at setting up Roth as an option to do for your solo 401k. There is even the option where you could do Roth as the employee, but then do the match from the employer in the pre-tax. So you can grow both buckets at the same time. So that is an option to choose from as well. Of course, diversify your investments inside your solo 401k. Again, the solo 401k is just the wrapper on the outside of an investment account. So inside that investment account, you can still go buy whatever you want. I wouldn't go buy one company and weigh it all there. We want to diversify your investments. So make sure you're building a portfolio with multiple stocks and bonds, so we're not taking too much risk in any one company. And then the last one, number 4, this is my favorite one, which is that you can hire your spouse and you can pay them a salary and they get to make a contribution to a solo 401k as well. Now, don't show them this presentation, and you can tell them that they need to do the dishes and the laundry to earn their pay and earn their solo 401k contribution. And I won't say anything, but with the spousal solo 401k, we now get to do another $23,500 as the spouse. And then you can do a match on top of that as well. So one thing you could do is you could pay your spouse exactly $23,500 a year, not a penny more. And they do 100% contribution to the solo 401k. So they contribute everything to that solo 401k. And then you get to match 25% of their salary. So 25% of their $23,000 salary comes out to around $6,000 a year. So between employer and employee for your spouse, you're doing another close to $30,000 for them. So $30,000 for the spouse, plus you could be doing another 30 or 40,000 for yourself. Now we're getting like $70,000 into this plan. So there's really a lot of capacity to put a lot of money in here and get a huge tax benefit. Now, it's not all sunshine and rainbows with the solo 401k. The main issue that we see with this plan is that because it is a 401k plan and you have to follow those ERISA laws, there's planning documents that have to be established. There's checks and balances that have to be done in this account. And so we recommend hiring a third-party administrator, which is basically someone that just helps with all the paperwork associated with this account, and pay them to make sure that you're in compliance at all times if you were ever to get audited for this plan. So it's only specific to the solo 401k. They have to worry about that. The company that I usually recommend to our clients, they only charge $360 a year. So it's not breaking the bank, but you do have to pay $360 a year to put money into this plan. So if you're only going to do $10,000 a year, it's not worth it to go pay $300 to $400 for a third-party administrator when you could choose something like a SEP IRA or a simple IRA and not have to pay anything at all. So the solo 401k is great, but it's really only for people who are going to be doing larger contributions into the account. And the other 4 plans that I listed here are not enough. If you can't do what you want to with these 3 other plans, as far as how much you want to contribute, then I go to the solo 401k. So it's a last resort for only those clients who want to do massive $30,000, $40,000 contributions into their plan. Otherwise, we can do one of these 3 options that's going to be a little bit cheaper, and you're not going to have to pay for that third-party administrator. As a summary, solo 401k, it's the end all be all from business retirement plans that you can set up if you're really trying to just stuff as much money as you can into these accounts for retirement. It's great for freelance court reporters, especially because you have more income and more wiggle room to save into this plan. But it could even be something that you set up as an official court reporter. And really the reason you would do that as an official court reporter is for your transcript income. Because if you only have that 25% limit for your transcript income as a official, and your transcript income's only, say, $15,000 a year, you're only going to be able to contribute a small amount. Whereas if you set up the solo 401k, now you could fill the whole thing up. You could do all 15,000 of your transcript income into that plan as an employer contribution and an employee contribution to really maximize that. Plan ahead for the solo 401k. You do have to have the plan established before December 31st, and also make your contributions for this year as the employee. You do have up until your tax filing, your corporate tax return, to do the employer match. So you have wiggle room on the match, but on the amount that you do as the employee, you need to get that into the account. I believe the latest I want to say is January 31st, just because you could still be figuring out those last paychecks that you did in December, but you don't have nearly as much wiggle room as you do with the employer contributions. So make sure you're staying on top of those deadlines. And then lastly, just coordinate with your accountant and also your financial advisor. Coordinate with your financial advisor, one, if this is the right plan and how much you want to contribute. If you don't have anyone that you're working with, definitely reach out to me and we can get kind of initial consultation set up and go through what contributions you want to do, what you have set up right now, and see if a solo 401k is a good fit for you. Regardless, though, I recommend every client I work with to work with an accountant when it comes to this, because you need to know exactly what is that threshold of how much money you can contribute into this account. And so they'll be able to tell you what are those limits and make sure that you're following and abiding by those laws. Other than that's everything for this week, and I'll see you all next time. Have a good rest of your week.